Okay, gang, in today's video, we're going to cover the financial concept that basically explains how people can fall into massive credit card debt. That concept is called compound interest. Now, if that all sounds dry, I get it. But before you click out of this video, let me tell you why I made it. Compound interest may sound like some boring corporate term, but if you're one of the 45% of US households who carry credit card debt, and you don't understand how compound interest works, then you're in a very vulnerable position to be overcome by your debts. Not to mention confused about how the heck things got so out of hand. So if I've convinced you to stick around, and if anything is confusing at any point in this video, I highly encourage you to pause, rewind, and rewatch anywhere that you need clarity. And heck, drop me a question in the comments if I can help. Okay, so let's dial back. First, credit cards are one way that we borrow money. Whatever you borrow, think about that as your principal amount, aka what you definitely have to pay back to the bank. Interest is an additional amount on top of that, which represents the cost of borrowing that money. Depending on your interest rate, how much you owe, and how long you owe it for, that will determine the amount of interest you ultimately pay. And remember, this is on top of the amount you originally borrowed and still owe to the bank. Now, compound interest, it's a doozy. It happens when you're charged interest on both the original amount you borrowed and any previously accrued interest. So imagine borrowing $1,500 on credit that you don't pay back right away. Your card company charges you an annual percentage rate of 12%. By the way, you don't need to understand the specific math behind that rate to get through this video. But if you have zero understanding of how percentages or interest rates work, stick around for the link to another video of mine that really breaks it all down. But going back to our example, a $1,500 principal amount at a 12% interest rate amounts to $15 of interest accrued after the first month that your balance is outstanding, aka unpaid. So the amount you technically owe to the bank now is $1,515. If you're able to pay back that full amount by the time your payment is due, then you're in the clear and the credit card clock effectively resets. But let's pretend you don't have the money to pay back any of it by the time of your second bill. That 12% interest rate isn't going to accrue on just the $1,500 that you borrowed anymore. It's now going to accrue on that $1,500 you originally spent, plus that $15 interest that you never paid. So your interest is going to accrue on $1,515 for this next month. If that was at all confusing, here's another good way to think about it. The fact that you didn't pay back that $15 in previously accrued interest means it basically just got lumped in to the $1,500 that you originally borrowed. So again, because your outstanding amount is higher, for the next bill, you aren't just adding another $15 to your balance. You're adding another $15.15, bringing your total owed up to $1,530.15. Okay, hang on, because I'm sure many of you are at home thinking, ma'am, why is she wigging out over an extra 15 cents? But focus on the full number that you now owe the bank. That's an extra $30.15 you didn't owe 2 months ago just for the privilege of not having to pay back your debt sooner. And if that still seems insignificant, let's try a more real example that's going to take our compound interest charges through the roof. According to my Google search at the time of this video, the average American carries about $6,380 in debt. And according to this other search, most Americans carry debt for 6 months to 1 year. But 7% can hold on to that debt for 2 to 5 years, which 7% is not an insignificant number of people, y'all. Now, I'm not claiming to know that these stats are true, but let's use them as an example anyway, just to see how compound interest works over time on a larger debt amount. Okay, here I have this online calculator. Let's plug in that average credit card debt amount, our 12% rate, and see what those numbers look like after 1 year. Now let's break down what these numbers mean. The simple interest calculation is the amount of interest you'd pay if the 12% rate only accrued on the $6,380 every single month and nothing else, aka no compound interest in the mix. The compound interest number is giving us the amount of interest we pay if the 12% accrued on both the $6,380 plus any previously accrued interest in the prior 11 months. In the 1-year scenario, the difference is small in relation to what the interest amounts actually are. But if you're anything like me and you have to pay back over $7,000 to the bank, you don't want to pay back any more than you have to. Now, let's see what this looks like after 2 years. Seeing in this scenario, the compound interest actually pushes your total amount owed past $8,000 compared to your simple interest. That is bananas when you remember that we've only borrowed $6,380 to begin with. Now, for fun, let's do that worst case scenario and see what 5 years looks like. Gang, look at that compound interest number. The total amount owed nearly doubles with compound interest. If any of you are out there thinking, what the f***, I am too. And I'm the one here explaining this to you all in the video. But truly, that is how compound interest catches people off guard. Now, if you're someone who has credit card debt, let me caveat by saying that the compound interest calculation may not be as clear-cut in your case, because this tool doesn't take into account whether you pay down any part of your balance during those years, which you hopefully do, nor does it take into account if your balance goes up due to purchases that you don't pay off quickly enough. You would definitely need something more intricate and specific to figure out your scenario. The point here, though, is just understanding the cluster fudge that is compound interest, which is this. Any accrued interest that you fail to pay on your outstanding balance causes the overall amount you owe to increase more quickly. And the longer you don't pay off that debt, the steeper that incline gets over time. It's a financial snowball that picks up speed and size as long as your credit card balance remains outstanding. So if you don't understand the full math behind compound interest, that's really okay, because that was never the point of this video. No one needs to be a mathematician to understand how compound interest can screw us. You just need to know this. The longer you leave your credit balances outstanding and allow interest to accrue, the more expensive your debt becomes. So try to pay off as much as you can whenever you can. Now, going back to something I said earlier, a general understanding of how interest rates and percentages work is important for foundational financial literacy. So if that's something you have zero clue about, check out my video breaking down interest rates in the simplest way I could possibly think of. And finally, if you know someone who's struggling with credit card debt and may not understand why, please share this video with them too, because knowing how your financials work is half the battle, truly, when it comes to taking back control of your financial life. So I hope this video was a helpful, thought-provoking crash course on compound interest and how it can really screw us when it comes to debt. If this video was helpful, please give it a thumbs up, and for more tips, be sure to subscribe.